Warren Buffett's investing tip number 10: be fearful when others are greedy and greedy when others are fearful. Concept. This principle suggests that investors should act counter to the prevailing market sentiment. When the market is euphoric and prices are high, it's time to be cautious and fearful. Conversely, when the market is in panic and prices are low, it's an opportunity to buy and be greedy. Market psychology. Understanding market psychology is crucial. Markets are often driven by emotions such as fear and greed, leading to overreactions in both directions. By recognizing these emotional extremes, investors can exploit opportunities for better returns. Understanding market sentiment. Greed in the market. Bull markets. During bull markets, prices rise, and investors become overly optimistic. The fear of missing out drives them to buy at increasingly higher prices, often leading to asset bubbles. Signs of greed. Overvaluation of assets, high trading volumes, excessive media hype, and widespread participation of inexperienced investors are indicators of market greed. Fear in the market. Bear markets. During bear markets, prices fall, and investors become pessimistic. The fear of further losses leads to panic selling, often driving prices below their intrinsic value. Signs of fear. Undervaluation of assets, low trading volumes, negative media coverage, and a general aversion to risk are indicators of market fear. Applying the principle. Being fearful when others are greedy. Assess valuations. When the market is euphoric, assess the valuations of assets. If prices are significantly above their intrinsic value, it's time to be cautious. Avoid overpaying. Resist the urge to buy overvalued assets. Overpaying reduces potential returns and increases the risk of losses if prices correct. Increase cash reserves. Consider selling overvalued assets and increasing cash reserves. This prepares you to take advantage of opportunities when the market corrects. Being greedy when others are fearful. Identify bargains. During market downturns, identify high-quality assets that are undervalued due to market fear. These assets often present great buying opportunities. Invest with conviction. Invest in undervalued assets with strong fundamentals. This requires confidence in your research and a long-term perspective. Stay disciplined. Avoid getting swayed by negative market sentiment. Stick to your investment strategy and focus on the intrinsic value of the assets. Historical examples. 2008 financial crisis. During the 2008 financial crisis, market fear led to a significant decline in asset prices. Buffett took advantage of this fear by investing in companies like Goldman Sachs and Bank of America at depressed prices. These investments yielded substantial returns as the market recovered. Dot-com bubble. In the late 1990s, market greed drove the prices of tech stocks to unsustainable levels. Buffett avoided investing in overvalued tech companies, demonstrating his caution during periods of excessive greed. When the bubble burst, many of these companies collapsed, but Berkshire Hathaway remained largely unaffected. Behavioral aspects. Emotional discipline. Controlling emotions. Successful investing requires controlling emotions. Fear and greed can cloud judgment and lead to poor investment decisions. Maintain a rational approach based on analysis rather than emotions. Patience. Patience is key. Opportunities to buy at low prices or sell at high prices don't occur frequently. Waiting for the right moment can yield significant rewards. Contrarian thinking. Against the herd. This principle often involves going against the herd. It requires confidence and conviction to buy when others are selling and sell when others are buying. Independent research. Conduct independent research and rely on your analysis rather than following market trends. This helps in identifying true value and making informed decisions. Practical strategies. Valuation metrics. Price-to-earnings ratio. Use valuation metrics like the price-to-earnings ratio to assess whether assets are overvalued or undervalued. A high price-to-earnings ratio may indicate overvaluation, while a low price-to-earnings ratio may suggest undervaluation. Discounted cash flow. Perform discounted cash flow analysis to estimate the intrinsic value of assets. Compare this value to the market price to identify potential buying or selling opportunities. 2. Diversification. Balanced portfolio. Maintain a balanced portfolio that includes a mix of assets. This helps manage risk and provides flexibility to capitalize on opportunities during market extremes. Asset allocation. Adjust asset allocation based on market conditions. Increase exposure to undervalued assets during market downturns and reduce exposure to overvalued assets during market booms. Cash reserves. Liquidity. Keep a portion of your portfolio in cash or liquid assets. This provides the flexibility to buy undervalued assets during market downturns without needing to sell existing holdings. Long-term focus. Investment horizon. Focus on the long-term potential of your investments. Short-term market fluctuations are less relevant if the underlying fundamentals of your investments remain strong. Reinvestment. Reinvest profits and dividends to compound growth over time. This enhances the long-term value of your portfolio. Buffett's approach. Intrinsic value focus. Buffett focuses on the intrinsic value of businesses. He invests in companies with strong fundamentals, reliable earnings, and durable competitive advantages, regardless of market sentiment. Selective investments. Buffett is selective about his investments, preferring to wait for the right opportunities. He avoids overpaying for assets, even if it means holding cash during periods of market exuberance. Patient capital. Berkshire Hathaway's structure allows for patient capital. Buffett does not face pressure to meet short-term performance targets, enabling him to take a long-term view and act decisively during market extremes. Challenges and considerations. Psychological pressure. Emotional stress. Acting against the prevailing market sentiment can be psychologically challenging. It requires confidence and conviction to withstand emotional pressure. Media influence. Media coverage can amplify market emotions. Staying informed but not swayed by sensational news is crucial for maintaining a rational approach. Market timing. Difficult to perfect. Perfectly timing the market is nearly impossible. Focus on identifying value and making decisions based on thorough analysis rather than attempting to predict short-term market movements. Risk management. Assessing risk. Even when being greedy during market downturns, assess the risks associated with each investment. Not all depressed assets are good investments. Focus on quality and fundamentals. Click the link below for more investment tips.